G'day Gain Squad! I'm so stoked you've joined us here in Sydney for another massive session at Goldie Gains. Let's see where the smart money is flowing today, because the last 72 hours have been a total mood for the markets. Today, we're breaking down the nuclear escalation in the Middle East and why gold isn't reacting the way we'd expect. We are also looking at the Reserve Bank of Australia's recent rate hike and the carnage it's causing on the ASX. Plus, we have a deep dive into the paper gold flush versus the massive physical demand from central banks and stackers. Real quick, this is just for news and fun, so please see a professional advisor before you drop any serious cash. So, gold getters, here is the big question. Are we seeing a structural crash or the greatest buying opportunity of the decade? Drop your take in the comments, smash that like button, and subscribe so you can always optimize this entry with us. Breaking news over the weekend. The conflict in the Middle East has shifted from conventional strikes to a nuclear frontier. On Saturday, March 21st, coordinated strikes under Operation Midnight Hammer hit the Natanz uranium enrichment complex in Iran. Tehran didn't wait around, retaliating with ballistic missiles targeting Israel's nuclear hub in Dimona, located southeast of Tel Aviv. This tit-for-tat escalation on nuclear sites is a proper shocker, ending the era of localized, limited retaliation in the region. The IAEA has confirmed the strikes but says there are no radiation leaks yet, though the tension is bloody mental. Usually, this kind of news would send gold to the moon, but the market's having a bit of a wobbler this Monday. Instead of a safe haven spike, we are seeing a massive liquidation as traders scramble for liquid cash to cover losses elsewhere. It's war in 2026, and the traditional correlations between gold and war are being completely rewritten before our eyes. Smart money is watching the Strait of Hormuz closely, as any further disruption could change the global energy map forever. For now, the fear of a full-scale regional war is keeping every global trading desk on high alert this morning. Let's look at the black gold, because West Texas Intermediate oil prices are absolutely on a roller coaster ride right now. WTI crude oil shot up toward $120 a barrel recently as tanker insurance in the Gulf was suspended. On this Monday, March 23rd, WTI is sitting around $97.86 as traders take some profits. We also need to talk about the OVX, which is essentially the fear index for the oil market, and it's exploding. The OVX index is currently trading above 100 points, a level that eclipses the high-stress phases of the last 5 years. When the OVX is this high, the market is pricing in daily oil price swings of up to 4.5%. That is an insane level of volatility that makes directional betting on oil extremely dangerous for most retail traders. High energy costs are acting like an additional tax on consumers, which is making the global inflation picture look pretty grim. Smart money knows that as long as the OVX stays elevated, we can expect heavy volatility to spill into the stock market. De-dollarization is also moving from a theory to a reality in the Strait of Hormuz over the last 48 hours. Reports are swirling that Iran is only allowing tankers through the strait if they settle the oil payments in Chinese yuan. This yuan for passage play is a direct hit on the petrodollar system that has dominated global trade for 50 years. By weaponizing this maritime choke point, Tehran is forcing energy importing nations to liquidate their US dollar assets. Roughly 20% of the world's oil and gas trade passes through that tiny stretch of water every single day. This move is being supported by the broader BRICS framework as they try to insulate themselves from US sanctions. While the US dollar index, the DXY, remains strong at 99.57, its structural foundation is definitely cracking. Gold getters should realize this is a long-term bull case for gold, even if the short-term price action is doing our heads in. The shift away from fiat currencies is accelerating, and central banks are hoovering up gold at record rates in response. Back home, our own Reserve Bank of Australia is staying tough, having recently hiked the cash rate to 4.10%. Governor Michelle Bullock delivered a 25 basis point hike on March 17th after a very tight 5-4 board vote. The RBA is worried that sticky inflation and soaring energy costs are going to linger longer than a bad sunburn. Electricity prices have jumped 30%, and our local bowsers are charging over $2 per litre for fuel. Money markets are already pricing in a 67% chance of another rate hike in May to 4.35%. This higher for longer stance from the RBA is putting a lot of pressure on Aussie households and small businesses. Governor Bullock has admitted that a downturn might be unavoidable if inflation doesn't start behaving itself soon. This hawkish outlier status is making the Australian dollar look quite attractive compared to other major global currencies. However, higher rates are a massive headwind for our local property market and consumer discretionary stocks. It's a delicate balancing act, and the RBA is clearly signalling that they aren't afraid to cause a bit of pain. The ASX 200 index is feeling the heat, officially entering correction territory this Monday, March 23rd. Our benchmark index is down 1.6% this morning, trading around 8,294 points. We've seen a 10% dip since the record highs on March 2nd, and 88% of the index is bleeding. There is proper carnage in the mining sector, with giants like BHP falling 2.6% today. Gold miners are doing it even tougher, with the gold index plunging 6.1% as bullion prices slide. The Aussie dollar pair is currently sitting at 0.7008, holding onto the 70-cent handle. Our dollar is actually the top performer among the get-in currencies right now because of our higher interest rates. Smart money is watching the 0.7080 level as a key pivot for the next big move. If we break above 71 cents, we could see a run towards 73, but global risk-off sentiment is a heavy anchor. For now, the ASX is looking as red as a kookaburra's beak, and investors are fleeing into cash and energy stocks. Over in the States, the Federal Reserve is also singing the higher for longer tune, which is weighing on the yellow metal. Jerome Powell kept the funds rate at 3.75%, signalling no cuts until inflation hits that 2% target. This has pushed Treasury yields higher, increasing the opportunity cost of holding gold, which doesn't pay any interest. Traders have even pushed back their expectations for any US rate cuts all the way into 2027. The energy shock from the Iran war has made the Fed's job nearly impossible, creating an inflation interest rate catch-22. As the US dollar stays strong, gold is being treated more like a source of liquidity than a safe haven. Institutional investors are liquidating gold to offset losses in their tech and equity portfolios as the market wobbles. Large holders, including sovereign wealth funds and Middle Eastern central banks, began converting gold to US dollars due to the war, and institutions selling off. That's what crashed the gold price this weekend. The big players were forced to sell, a record-breaking fire sale of liquid assets. This macro environment is the main hurdle keeping gold from reclaiming its psychological floor at $5,000. Smart money knows the Fed is trapped, and eventually they will have to choose between saving the dollar or the economy. Let's do a deep dive into the paper gold flush, because this is where the real market drama is happening right now. The gold price you see flickering on your screen is largely set by the paper market futures, ETFs, and leverage. When the dollar spikes, these leveraged traders get hit with massive margin calls and are forced to sell immediately. Gold is sold not because it's a bad investment, but because it's highly liquid and traders need cash fast. This creates a flush that drives the digital price down, regardless of what is happening in the real world. We saw gold spike to over 5,400 on the Hormuz news, only to reverse hard as positions were flushed. It's a classic case of the paper tail wagging the physical dog, and it can be brutal for anyone using too much leverage. This is why many experienced gold getters prefer to hold physical metal rather than just digital claims on a screen. You can't get a margin call on a gold coin sitting in your safe at home, and that is a massive advantage. These flushes are essentially a giant reset button, shaking out the weak hands and resetting the market for the next leg. While the paper market is having a meltdown, the physical gold market is telling a completely different story, traders. Physical premiums are staying elevated because demand from central banks and stackers is staying rock solid. Central banks have been adding gold for 16 straight years, and 43% plan to increase their holdings further. In fact, central bank gold holdings recently exceeded US Treasury reserves for the first time since 1996. People want the real stuff in their hands, not just a digital promise that might disappear in a liquidity crisis. There is currently a massive mismatch on the COMEX between paper open interest and the actual physical gold registered. This divergence suggests that if everyone asked for physical delivery at once, the system would absolutely break. Smart money is using these price dips to accumulate physical metal at a discount compared to just a week ago. JP Morgan still has a price target of $6,300 for gold by the end of the year. So, while the digital price looks like a disaster, the underlying demand for the physical asset has never been stronger. Over on Wall Street Bets and Reddit, the sentiment is a wild mix of cynical memes and total guh moments. Some retail traders are calling this a meme metal trade, suggesting that big institutions are just looking to dump on them. The term guh has made a comeback as retail users show off massive losses on their deep out-of-the-money call options. Many individual investors are stuck in the sunk cost fallacy, holding on to small-cap tech stocks that have dropped 60%. There's a lot of noise about market manipulation, with users pointing to the weird gaps between paper and physical prices. Seasoned investors on these platforms are advising a move toward cash and money market funds until the oil chaos settles. It's a proper bloodbath for anyone who was over-leveraged going into the weekend's nuclear headlines. But some contrarians are starting to post their buy-the-dip orders, betting that the bottom is finally in for the year. It's a wild west out there in the forums, but it's a great place to gauge the level of retail fear in the market. Remember, gold getters, when everyone else is panicking, that's usually when the most golden entries appear. Let's optimize this entry by looking at the technical indicators on the 1 hour, 4 hour, and daily chart. On the 1 hour chart, gold has broken below a bearish flag, targeting a slide toward 4,450. The price is currently oscillating between the VWAP and the 20-period moving average, showing major intraday uncertainty. On the 4 hour chart, we saw a morning star and a hammer candle form, which is a proper golden entry signal. The 4 hour RSI has turned up from the oversold zone and is currently rising toward the 33 level. However, the daily chart is still a strong sell after gold broke below its 50-day moving average at 4,960. The daily RSI is sitting at an extremely oversold 20.93, suggesting a bounce is way overdue. Watch out for a death cross if the 50-day average crosses below the 200-day average, which would be quite grim. Immediate support is at 4,374, while we need to reclaim 4,700 to turn bullish. To summarize, the Middle East conflict has escalated to nuclear sites, sending shockwaves through every global market. Oil prices and volatility are sky high, with the OVX index above 100 points signaling extreme stress. De-dollarization is hitting the petrodollar system hard as Iran demands Yuan for passage through the Strait of Hormuz. The RBA has hiked our local rates to 4.10%, sending the ASX 200 into a correction. Gold is being hammered by a paper flush and margin calls, even though physical demand remains at record levels. Technically, gold is in a strong sell on the daily chart, but is showing signs of a tactical bounce on the 4 hour. Higher for longer from the Fed and a strong US dollar are the main hurdles we need to clear for a real rally. So, Gain Squad, what is your move? Are you buying this physical dip or waiting for the technicals to settle down? Let me know your thoughts on the crazy fall in gold prices this weekend in the comments below. Is it time to buy? Make sure to hit that like button and subscribe to Goldie Gains so you never miss a market hop. Keep your positions tight and gains golden. I'll see you at the next close. Cheers, stay active, stay legendary. Catch ya.